Hello and welcome to the latest week ahead. Of course, everything that's happening in the Middle East continues to dominate financial markets, but we are coming into a week that is going to be focused around central banks as well. The likes of the FOMC, the ECB, the Bank of Japan, and the Bank of England all announcing their latest monetary policy decisions. So with everything that's happening in the crude market alongside those major events, let's look at the week ahead for the week starting Monday, the 16th of March. As ever, we're going to look at the main events according to the Trading Economics economic calendar, kicking off on Monday with the industrial production and retail sales numbers out of China. That's part of a wider data dump from the Chinese economy. Also, inflation data out of Canada, so watch out for potential volatility in the CAD. Then we kick off things from a central bank perspective with the RBA, and that really highlights that pretty much all of the major central banks are announcing this week, because the next day we have the Bank of Canada, the FOMC. Then on Thursday, we've got the Bank of Japan, Bank of England, and the ECB all coming into play. Now, I couldn't necessarily touch on all of them, so I've just grabbed a couple of the central bank announcements. But certainly this does make for a particularly busy week for traders as they try to gauge exactly what their state of play is now, given what's happening in the Middle East. Now, the fact of the matter is that you and I, and probably even Donald Trump, doesn't necessarily know how this is going to play out. And so the central bankers inherently are likely to just kind of take a relatively cautious approach rather than telling you exactly what is going to happen. Inflation's going to do this, and therefore we're going to have to do that with rates. So probably you're going to see a lot of we'll wait and see. But there's going to be a lot of caution for these central banks. Now, let's kick things off in terms of the economic calendar with the US. And you can see here that for the rest of the week, by and large, it's all sort of tier 2 data. So relatively interesting, but nothing that's really going to move the needle, I don't think. You can see the weekly ADP, the pending home sales, PPI inflation, factory orders, initial jobless claims, fully fed manufacturing, all of that. But really, the main event of the week comes on Wednesday, where we see the FOMC announce their latest monetary policy decision as we creep ever closer to that May meeting, where we're expecting, or it's not May meeting, May, and then the June meeting, where we were expecting to see Kevin Walsh as the new Federal Reserve governor. Now, you can see here essentially that markets are expecting us to keep rates steady, and by and large that is what we're going to see. There's too much uncertainty in the markets right now, too much uncertainty in terms of inflation in particular. And now looking forward, we do have the possibility that we're going to see higher inflation because of energy, but also dampened growth. So the job of the Federal Reserve by and large is to control a dual mandate, and that is to look after unemployment and to look after inflation. The problem for them is when you see high inflation and high unemployment, and therefore you've got to essentially prioritize one over the other. That's something that they have been kind of trying to deal with over the course of the past year. And the problem is that everything that's happening in terms of the Middle East right now points towards the possibility of stagflation, which is elevated inflation coming into play, but then dampened growth prospects alongside that. So if we see a sharp spike in terms of inflation, then that puts pressure on the wallets of your everyday person. They're likely to spend less. Your businesses are likely to have higher costs, and therefore they either pass it on or they become less profitable and probably invest less. And therefore the job of the Fed is to try and stimulate the economy when they need it, but they can't necessarily do that if they see a major surge in terms of inflation. So again, it sort of looks like more of the same looking ahead. The caveat here is we don't necessarily know how long this is going to play out. If Donald Trump suddenly says tomorrow, right, we've struck an agreement and everything's going to go back to normal, it's not going to go back to normal immediately. But certainly that will mitigate much of the potential fallout, in particular because of the fact that we've seen something like 400 million barrels of crude being released to the market by the IEA. That isn't instantaneous, but that is an outlook for what they're going to do going forward. And certainly that, to an extent, does provide a short-term buffer for markets. This is the outlook in terms of the Federal Reserve for the rest of the year. And notably, at the moment, the base case scenario is we maybe get one cut. That's it. And what's interesting about this coming meeting is that it also comes alongside the dot plot. This is the previous dot plot from the back end of last year. We get it 4 times a year. And you can see here that by and large, whilst they were fairly confident on where rates were going to be at the back end of last year, they didn't really have a clue where it's going to be over the course of the coming years. And it'll be interesting to note under Kevin Walsh whether this changes, but right now the committee looks completely split over exactly where they think rates should be, because you're seeing each of these columns stacked with fairly equal numbers. So we don't necessarily have a common theme in terms of where rates should be by the end of each year right now. The downward trajectory is just about highlighted, but that's only because the bottom end seems to sort of move gradually lower, but not by much. So the Federal Reserve are kind of stuck in a position that they don't really know where to go. And that could be perceived as a damning indictment of Jay Powell, that he doesn't necessarily provide enough leadership to essentially have everyone rally behind a central theory or a central outlook. Instead, everyone has their own thoughts of what they should do from here. And that, I guess, is part of the problem of when you have elevated inflation, but also concerns around the jobs market. So rising unemployment, weak payrolls data, and questions around the growth, but more so the jobs market. So this is going to be interesting. So keep an eye out for the dot plot that's going to be released. Alongside that, we have projections coming out, economic projections, the likes of GDP, the likes of unemployment, and inflation. The inflation part of it will be interesting, but I guess ultimately it's a case of pin the tail on the donkey right now. They haven't got a clue what's going to happen in terms of energy prices, and therefore they haven't got a clue about what's going to happen in terms of inflation going forward, and nor do I or anyone else for that matter. And so, yeah, there's a good chance that this inflation projection, whilst it could be interesting at the beginning, it's kind of probably going to become fairly defunct within weeks, because once we see the resolution to the crisis, it's only then that we see exactly how things are likely to shake out in terms of inflation. Because we could, you know, for all we know, we see some sort of an agreement that sees the Iranians being able to freely pump as they wish and export around the world, or not, or the opposite, where they essentially throughout this crisis take out all of the Iranian oil facilities with a view to saying, well, they wouldn't necessarily have the funds to be able to redevelop their army and their military capabilities as swiftly. That's in the event that they don't necessarily see a regime change. So let's see a regime change. Great. All of a sudden, Iran are our partners. We're going to let them pump and export at will. The flip side of it is, well, we'll let you keep the regime in charge, but we're going to smash everything up, and we're going to make it so that it's going to be difficult for you to actually fund any revamp of your military. So two completely different scenarios that have very different outlooks in terms of the future, in terms of supply within the oil and gas market. And that will massively inform exactly where prices are going, let alone the question mark on just how long the crisis goes on for. So again, something interesting to watch, but something that's likely to essentially fluctuate down the line. And then I wanted to show you guys this relationship. So this is taking a look at things from the perspective of the US dollar. It's something that we'll sort of go on to. But from the perspective of sort of pricing around exactly where the Federal Reserve is going to go, we're seeing that influence in the dollar heavily. So the Fed essentially were expected to cut over the coming period, essentially 2 rate cuts for the back end of the year, in the second half of the year. That's shifted, and you can see that with the US 2-year yield. That rise in terms of the 2-year yield over the course of the past week and a bit essentially means that people are now wiping off proposed rate cuts or expected rate cuts from the board. And so we're seeing the US dollar rising as a result. So this is certainly something that worth watching for you guys. Keep an eye out on the 2-year yield, overlay it with the US dollar. And if the 2-year yield moves in one direction, it's probably going to see the US dollar following suit in response. So let's look at not the US dollar first and foremost, although we will get onto it in a sec. Let's just jump onto the chart for the S&P 500. And so what we can see here is, let's look at the weekly time frame. This topping pattern coming into play here. So you might say, well, look at everything that's happened in the Middle East. This huge crisis, the massive destruction of oil and gas capabilities and supplies, and you're only down, well, now 4% and a bit, right? But, things haven't necessarily moved that much in terms of oil either. And so let's just say, get the 4-hour chart on and we'll put WTI. So doesn't look that interesting here. If we invert it to say high oil prices are bad for markets, well, it looks very interesting there. So you can see here that we are very closely tracking over the course of this crisis, because remember, it only really happened at the beginning of the month. We're closely tracking what's happening in oil. What does that mean? Well, it means that essentially if you see oil prices spike into 120, 150, $200, then we're going to see equity markets go with it. So there's major question marks on exactly what's happening going forward, but certainly the trajectory of oil is essentially driving exactly what's happening in terms of equity markets right now. And that's not the only thing. The caveat to that also is that we're looking in terms of US 2-year yields, like I just showed you guys. And again, we've got that moving towards the upside. If we invert that, we've also got that similar kind of relationship. So what does this mean? Well, higher oil prices drive higher expectation of Federal Reserve rates. It drives the US 2-year yield higher, and that inverse correlation between the likes of oil and equity markets means that we then drive the likes of equities lower. So if we see out of this FOMC meeting something that alludes to the idea that they're going to be very patient going forward, people start calling for rate hikes, things like that, then we're likely to see a higher 2-year yield, and we're likely to see the S&P 500 moving towards the downside. If they come out with anything that is perceived to be relatively dovish, which seems very unlikely, then it's the reverse, right? It's good for equities. It'd be bad for the 2-year yield and drive that lower. But in all likeliness, we're going to see a lot of wait and sees when it comes to pretty much all the central banks at the moment. Let's get back onto it and see exactly what the next one is, and that is the UK. The UK has not only the rate decision from the Bank of England on Thursday, but we also see the jobs report coming out earlier on in the day. Markets aren't expecting too much. Unemployment to remain flat, average earnings to remain flat. The claimant count figure expected to decline down to 18K from 28.6K. Just quickly, we'll be able to jump onto the chart for the sort of jobs market. And you can see here we've got unemployment on the rise and claimants on the rise. Not necessarily the greatest combination for the UK. So there's some question marks, and there's a perception that the Bank of England do need to step in. But it's really a question of whether they are capable to do so given the backdrop in terms of inflation. And we can see here, whilst UK inflation stands roughly around 3 to 3.1%, depending on whether you're looking at core or headline inflation, you can see that the perception is that once the April figure drops out, we can see ourselves back down towards the 1 to 2%, as you see from the 9-month annualized figure at the bottom of this chart. What does that mean? Well, the idea was that soon enough, the Bank of England would essentially see the starting gun fired, and they'd be able to cut rates at will to get rates down to exactly where they think the UK economy needs it, especially given the backdrop of rising unemployment. However, there's a major caveat to that now, and that is the rise in terms of inflation expectations given the surge in terms of energy prices. So if this conflict continues, if it sparks inflation around the world, you're of course talking about oil and gas, but also the flow of different chemicals, the flow of ammonia and fertilizer, things that essentially could spark a sharp surge in terms of food prices down the line. Well, soon enough, we could see another bout of inflation, and suddenly the Bank of England are held back. That would have a tangible impact on the pound. We have been seeing some repricing of late already, and you can see that here. Markets have been expecting rate cuts. Now, suddenly we're looking here on the probability distribution for rates under the Bank of England point towards a possibility of rate hikes. That is a significant shift, but ultimately, I don't expect either right now, especially at this meeting, but I expect, as we said, more of the same around the idea of patience and a willingness to see how it plays out, because we don't know how it's going to play out, and that really will massively drive expectations going forward. If we're just talking about a 2-week blip that sees crude up to $120 momentarily and then drops down, hangs around $100 and then goes back down to 70 over the course of a month, that's not a problem. And we could soon enough see a return to that dovish rhetoric that sees expectations of rate cuts coming into play in the second half of the year in particular, but potentially at the back end of Q2. However, if we see the energy prices remaining elevated for months to come, well, then suddenly things don't necessarily look all too great on that front. In terms of the market, just wanted to bring up, here we go, the chart for cable. Now, bearing in mind, we have got two central banks that were expected to cut rates, but generally US inflation has proven much more sticky, in part, I think, influenced by tariffs, but also the UK has just got this sort of one-off inflation metric in the April number that needs to drop out, and therefore things were on the cusp of looking like we could start seeing some rate cuts coming into play. Nonetheless, certainly the narrative has shifted as we see the US dollar really coming into its own. And so we're seeing this weakening playing out here at the moment for the likes of cable. I would expect more of the same. If we see that strengthening, the narrative around the US dollar strengthening, if we see energy prices rise, let's just quickly jump on the put that relationship in terms of US crude and see exactly how that's playing out, so we can see that similar relationship. So really things are being driven by oil in a big manner. So more of the same in terms of weakness, as long as energy prices continue to rise. If they don't, then we have to start sort of surveying the landscape to see how much damage has been done and how lasting we think the upward inflation pressures might essentially last for. But yeah, for the time being, as long as oil is on the rise, it points towards the possibility of further downside coming into play for this pair. But certainly with the Bank of England coming forth for this meeting, it's definitely going to be a good opportunity for us to see exactly how they see things shaping up going forward and how that impacts their expectations in terms of monetary policy. And finally, we've talked about it pretty much throughout, and we're going to continue to do so because oil will remain the key factor that drives markets over the course of the coming week. Bearing in mind, over the course of the weekend, we might suddenly see them strike a deal, but it seems very unlikely from here. This chart, I think, is interesting because it essentially highlights that whilst we do have that 400 million barrel per day, 400 million barrel release that has been pledged by the IEA members, that is a record number, but it amounts to something like 1 to 2 million barrels per day. And certainly if you look at the loss of supply that we're seeing coming from the shutdown thus far, you're talking about 10 to 15 million barrels per day that are being impacted. So essentially they either ramp it up in terms of the daily rate and therefore it gets exhausted pretty quickly, or they slow roll it. It mitigates part of the effect and they can hold out for a longer period of time, but doesn't cover the whole thing, and we still see upside in terms of prices. And certainly markets are looking through this anyway because they see this as a stopgap. They see it as a temporary plaster that isn't necessarily going to stem the flow of exactly what the problem is. And the problem is we're seeing this huge catastrophic destruction in terms of supply of oil to the market. We're seeing attacks on refineries. We're seeing the explosions on oil tankers. I mean, look, ultimately, this isn't something that's going to be resolved overnight. And even if it was, it would still be a problem. And that means that higher energy prices do look likely as we go forward. As you can see here, in normal times, roughly the region produces about 30 million barrels per day. So we're seeing something like half of that production being impacted. We've still got some other ways of getting crude out the area. I say I'm not personally getting crude out of the Middle East. Thankfully, it doesn't necessarily sound like an easy job. But one part of it is the Saudi Arabia east to west pipeline that's pretty much running at full capacity right now. And it seems like a target for me. I mean, if we see an escalation, that's another potential area that we could see targeting, in which case that's again going to potentially spark another surge in terms of oil prices. So certainly, you know, some of these things you might say, oh, Iran aren't necessarily attacking that at least. Well, you know, maybe they're just holding back so that they can continue to escalate. And this is really a case of game theory that's probably going to be studied for years to come. And certainly the Iranians seem to have the whole thing mapped out probably for many years ago. Whether the US have that same approach, I'm not so sure, quite frankly. But we can see that the Iranians have managed to essentially lock off the Straits of Hormuz. There's talk about potentially some Indian flagged ships moving through the waterways there. But certainly at the moment, I would say probably the only oil going through there is Iranian oil, because they still need their money. And the rest of the world also kind of wants oil to flow. So it's like there's not really much reason to start trying to blow up their oil tankers as things stand. But certainly, I think the oil and gas issue is going to be the key one once again. It's going to be absolutely crucial because of the impact on inflation expectations. Now, let's look at the sort of wider context, and we can see here that massive surge that we've seen thus far. We're not even halfway into the month, and we've already seen a huge pop. We've seen a bit of a pullback here. If we look at, say, the daily time frame, you can see that sharp rally and then pullback as Donald Trump essentially said, oh, we're pretty much done here. And then we've been gradually regaining ground since then. And that exactly highlights what we're dealing with right now. On one side, you have the destruction of capabilities in the region, the shut-ins, the idea that essentially even when we do see a resolution, it's going to take a long time to get things back up and running to the same degree that they were previously. Then you've got question marks on just how long this conflict's going to go on for. And on the other hand, you've essentially just got Donald Trump constantly saying, we don't really have any more targets to hit. We're probably pretty much done here. We could call it off any day now. And that, if you look at this big red candle, did work the first time around. And it might work in the future, but I think it's almost like the boy who cried wolf. The more that you use that same trick, the less effective it will become. And so at some point, that sort of rhetoric or those words actually have to turn into something like, oh, we've got a meeting in Geneva and we're going to flesh it out with some sort of representative, probably the Qataris again. We're not there right now. And until we are, I think we're likely to continue to move towards the upside. We've seen, let's look at the hourly time frame. I think that's the best one. So we've seen this sort of basing pattern form over the course of the week, but now that break up through 88.5, the pullback into support, now we're pushing higher once again. I think it can be quite swift in terms of the move towards the upside, particularly if things continue to worsen. But to some extent, we're kind of desensitized by it all, right? I mean, the idea of the headlines is coming so thick and fast that it's like, oh, suddenly another refinery's been hit or another tanker's been hit. And we don't necessarily see a massive reaction. But I do think one of the main things that's going to impact it is going to be just the passing of time. With each day that passes without an agreement or without some sort of signal that we're approaching it, I just think we're likely to creep higher. If we do see a targeting of something major like the East to West pipeline in Saudi, that could provide that sharp leg higher. But because of the balancing in terms of the market, that essentially people don't necessarily want to be caught offside if we suddenly did see an announcement that they've got an agreement or they're having a meeting to end it or they're just pulling out. That holds people back a bit, but I do think we're likely to continue in this upward trajectory as we move forward without such a breakthrough. So this is driving everything. I mean, we'll go back to it, but let's just add some of these things on, right? So we've got the US 2-year yield, we've got gold, we've got the S&P 500. Let's just stick with that for the time being. So then we've got, let's just try and invert some of this stuff, trying to see what's where. So there we go. That's one of them. And then we've got, let's try that one. No, we don't want to invert that one. Do we want to invert? Yep, there we go. So essentially there it is. So you've got the price of oil, which is the candles, and then you've got the 2-year yield, which of course half of these are inverted, but we've got the 2-year yield, and one more is the dollar index. There we go. So where oil goes, the rest will follow. And essentially, you're just seeing exactly that right now. So here we go. Let's go on a 15-minute chart and see how closely correlated that is. I mean, that's crazy. Look at that, right? Oil is dominating all of it. Where oil goes, it influences rate expectations, were highlighted by the 2-year yield. That influences the likes of the US dollar. That influences the likes of gold. and influences the value of US stock markets under the S&P 500 as we see here. And so it's all correlated perfectly at the moment, and it all centers around inflation fears in my mind. And so really, if you want to know where your market of choice is moving, well, just look at oil, and that's going to tell you exactly where to go. That's all for today. I hope you enjoyed this and it was useful for you. Make sure to like, subscribe, send it to your friends. It's much appreciated. Other than that, yeah, I mean, the caveat here is that everything can just turn on its head in an instant, but I don't necessarily think it will. I think it's probably going to be a good couple of weeks more. And I think Trump's probably going to be trying in the meanwhile to allude to it being only a day away, because he sees the value of doing exactly that. But like I said, that only works oh so many times. Thanks a lot for joining me. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead. Thank you.